Welcome to our course on how to build and utilize a 13-week cash flow model to maintain the financial stability of a business. Now, as I'm sure you already know, one of the key factors in the success of business is properly maintaining cash balances and understanding where cash is going on a week-to-week basis so that you can make informed decisions on controlling all aspects of your cash balances. With that, let's kind of go through a little summary of what you're going to be learning in this course, that at the end of which you will be able to create your own 13-week cash flow model, including a projection, a results page, as well as a variance page, enabling you to analyze week-to-week variances. So first off, in order to pull together a 13-week cash flow model, you need to gather some historical information, because we always want to project the future with one eye looking at history or the past. So the first thing we're going to do, we're going to gather our spend history from our accounting system. Now in this course, we're going to just be using QuickBooks as our accounting system because we have ready access to QuickBooks files and the ability to show you how to generate reports. Now, whatever accounting system you're using, you're going to have to come up with similar reports to gather similar data. But if you're using QuickBooks, then this is going to make life a little bit easier for you. Next, we're going to take a look at our income history, and we're going to talk about two different types of income models, or at least where cash receipts are coming from. And you have basically two different models. You have the cash receipts model. So this is where when a sale is made, cash is collected at the moment of sale. So a grocery store would be an example of this, or a web store would be another example. When the sale is made, the cash is collected. An invoice model is a business-to-business model where either services or parts or products are purchased by a customer, and the seller issues an invoice with some terms, and those terms may be payment in 15 days, 30 days, 60 days, whatever they're able to invoice on. Next, we're going to talk about an important aspect to the invoice model, which is a metric called Days Sales Receivable. Now, this is a measurement of how many days it takes from the time that a customer is invoiced to the time that the cash is collected. So that may be, or hopefully is, the terms that I was just talking about a minute ago. So if a business negotiates 30-day terms with a customer, then from the point of time when a invoice is issued or when a product is received, that clock starts. And then in theory, the company should receive payment from their customer 30 days later, or whatever's negotiated. Next, we're going to start to work on our cash flow model. And the first part of that model is building the projection. Now, the projection is going to be the integration of both the income that we will be forecasting as well as the spend projections. And both these are going to be based on the history that we come up with in the previous sections. Now, in our example, we're going to be using a business-to-business example that is issuing invoices, and we're going to be looking at what the Days Sales Receivable, or DSR, projection and how that's used to estimate what the cash receipts are going to be on a week-to-week basis. Then we're going to leverage the same model that we use in the projection to build a model to collect actuals over each one of the weekly periods as time passes. And this is going to be an important component to analyzing or understanding our cash flow model by analyzing how results differ relative to our projection over time, because one, that tells us when we need to take action to do something different. Maybe we have more cash than we thought, or maybe we have less cash than we thought, but certainly it will also help us figure out how to improve the next 13-week forecast. And then we're going to have a variance model that just basically consolidates all our variances between our projection and our actual results, showing where we have favorable and unfavorable variances. Then in the next section, we're going to talk about improving the accuracy of our initial model. Now, our first model is going to be a bit simplistic, and that's intentional, but most businesses are a bit more complex than our example. So we're going to show you a way to more accurately forecast accounts receivable when you have, say, large customers that are paying you. So we're going to break out some of our larger customers and then group all of our smaller customers, and we're going to show you a model on how you do that so that you can better estimate what cash receipts are going to be from large customers. And then next, we're also going to get into a way to forecast for some of our cash outlays through accounts payable when we have major vendors. So if you're a company that is, for example, a distributor, you're going to have some major vendors that are sending you product that you sell or that you may manufacture and turn into other products, but we're going to be showing you a way to better estimate when those cash outlays are supposed to happen. And then finally, we're going to integrate the two together into a more robust model in that it's a more complex model for larger businesses so that you can kind of see the differences in between our initial simplistic model that we use to help you kind of understand the process, and then you can kind of get an idea as to how you might be improving your own model depending on the size of your business. And then each chapter has the Excel models available for download so that you can play around with them and look at all the formulas. And we also have a survey that we'd like you to take at the end. So let's move on to chapter 1.